Simkiza, and today we'll be looking at the fixed interest rate as it applies to pensions or annuities, which is provided by the fourth schedule to the Income Tax Act. So if you take a pensioner who's just earning one annuity from an insurer, the payee tax tables are designed so that as that annuitant earns that annuity, payee is collected on a monthly basis. For example, if the annuitant is paying in a monthly basis. So as that annuity comes in, a portion of that gets withheld as payee tax, pay as you earn, which is payable over to SARS. The situation gets a bit complex for pensioners who are who have more than one source of income. In other words, it's easy to collect payee from the annuity because the administrator knows how much the annuity is, and simply they deduct in terms of the tax tables, and I'll take you through an example of that. So that's quite easy. However, the challenge for people with more than one source of income is that, let's take an example of somebody who's also earning rental income. Now, they could wait until the end of the year in order to do their final assessment, in order to find out how much tax they are in for. But the problem or the threat with that is that if during the year they take comforts that the payee has been paid in terms of the annuity, the worry is that there could be a big debt at the end, a tax debt, after calculating or after factoring in that rental income that might push them to a higher tax bracket. So in other words, after doing all your calculations at the year end, all of a sudden the pensioner could be sitting with a tax debt that they have to actually pay into SARS. So in order to reduce the threat of this tax debt at year end, what SARS has done is to really create a system. So it's not an extra new tax. It's to create a system whereby we know that, for example, you've had the same annuity the previous year, and we know that you've disclosed to us that you earn an extra income through rental income, for example. So then we know that you're going to be at year end sitting with a tax bill. So why don't we try and reduce that tax bill by upfront deducting it from the annuity that you are currently earning? Could be from more than one annuity, but at least now you are pre-funding for that tax liability that might finally come to shock you at the end of the final tax year when you do your final assessment. So in pre-funding for that possible tax debt at the end of the year, what SARS has done is to assist pensioners who have income from more than one source, is to calculate a rate at which to deduct from their annuity that they're currently earning. It's possibly going to be higher, obviously, because they're going to be sitting in a higher tax bracket, as we'll see in an example, so that at least they start pre-funding for that tax bill. So it's not driven from the assurers or the administrators of these funds. It's a directive coming from SARS to say, let's do it this way in order to collect these taxes via a payee system, which is far more a simpler way of collecting taxes for them. So I think let's look at an example. So I've just got a simple example here of how to calculate tax. I've just used a person, let's call him Mr. A. He earns an annuity of 10,000 rands per annum, which gives him a total of 120,000 rands per annum. Now, if we had to just work out his tax, we know that according to the tax tables, the revised tax tables for 2023, the first 91,250 is tax-free, and anything above that is taxable at 18%. So therefore, the calculation goes as 120,000 rands per annum. You take off the first 91,250, which is a tax threshold. You're left with 28,750, which then you multiply by the rate as per the tax table at 18%, which gives you a total of tax payable for the year of 5,175. Now, the nice part about the payee system is that 5,175 would have been already collected by the administrator of the fund. So there's tables that are used in order to figure out how much payee as the 10,000 rands annuity is paid to the annuitant, to figure out how much should we be deducting in order to make sure that 5,175,000 rands is taken care of. So in terms of those tax tables, the amount to be deducted as payee from the annuity of 10,000 rands on a monthly basis is 431 rands 25 cents. So basically what happens, the 10,000 rands gets paid by the administrator. However, they withhold payee tax of 431 rands 25 cents, and they pay the difference to the annuitant, thereby having collected the tax. So at the end of the tax year, by just using the payee system, without talking about credits and rebates and all of those things, this tax, the payer would be sitting in a nil position. In other words, would not have to pay in any taxes. Now, for now, just focusing on the A and B part of the next of this slide. Let's assume that on top of this 10,000 rands that our Mr. A earns, he also earns an income from rental income from a property that he leases out. So that income is also 10,000 rands a month. So what I've done here is, in terms of his total income, I've added the 10,000 rands annuity times 12, which is 120,000 rands per annum, plus the 10,000 rands rental income per month that he earns, times that by 12, which is another 120,000 rands, and simply added them to give you a total figure of his total income for that tax year of 240,000 rands. Now, just based on that, when you look at B, so if you look at the tax tables, that will put him at a marginal tax rate of 26%, and you'll have to work out what his tax would be. So in terms of that table, we take 40,680 plus 26% of the amount over and above, which have worked out to be 14,000 rands already. So and then the calculation goes on to 40,000 rands, 680 plus 3,600, which gives you a total of his tax liability for that tax year of 44,320, just for that tax year. Now, just to pause there for a little bit. So in the first scenario where the annuitant just earns an annuity, it's easy to calculate because you just deduct payee as we've explained, and then at the end of the tax year, they sit with no tax liability. However, in this second scenario where there's an annuity, on top of that, there's also rental income that's coming in. At the end of the tax year, the pensioner will be sitting, as we've just calculated, on the previous slide, with a tax liability of just over 44,000 rands. Now, it is that tax liability which in the new system that SARS has introduced from the 1st of March is trying to alleviate from a pensioner's perspective, to try and collect more taxes from the annuity that the pensioner earns in order to try and chip away at that tax liability. So now essentially, in order to chip away at that tax liability, we've got to figure out at what higher rate to tax the annuity of 10,000 rands that the pensioner receives in order to buffer in order to take care of that tax liability we've worked out of just over 44,000 rands. And before we go into the calculations, I'll just go quickly through some of the abbreviations in terms of the calculation. So in terms of some definitions, A is going to be standing for remunerations in terms of the fourth schedule, which includes all sources of income. In our scenario, the annuity and the rental income. B stands for the normal tax on A before rebates and tax credits, that calculation of just over 44,000 tax liability that we've done. C is the primary, secondary, or tertiary rebate. I've just assumed that our taxpayer is under 65, so I've just used the primary rebate. And then D is a medical tax credit, as per source code 4116 on your assessment. E then becomes the result of taking B less the primary rebates and then less the medical tax credits in our example. And then you finally work out the fixed payee rate, which is basically the answer from E. divided by the total remuneration. So let's have a look at an example. So in order to ultimately work out the fixed rate, A is the total of his income of all sources, 240 that we've discussed. And then normal tax on that before rebates and any credits we've worked out in terms of the marginal tax rate of 26% to be 44,320. And for C, for people under 65, the primary rebate is 16,420. And then D, I've just assumed that our pensioner contributes to a medical aid, and SARS knows this already. And previously it was 347 rands in terms of his medical tax credits, 347 rands times 12, which gives me the total value of 4,164. What we then do is take its total tax liability that we've calculated under B, and we minus the primary rebate of 16,425, which is known, and then also, which is another known for SARS, we minus the tax credits, 4,164. Then the tax liability that's still to be paid would be 23,731. Now, in order to work out the effective rate, we simply take that figure and we divide it by the total amount of his income, which is 240,000, and then we get a new fixed rate of 9.89%, which is going to be applicable on his annuity. Now, just in terms of some points for our clients, the first thing is they could do nothing. And the reason I say that is, remember, this is driven from SARS. So SARS issued the directives to the administrators to apply this higher or fixed rate where an annuitant earns sources of income, has more than one source of income. So that the administrators are sitting with, and if the client wishes to opt out of it, then they've got to do it in writing to opt out of it. But otherwise, if they're happy with it, then they could just simply do nothing and let the higher rate take effect. So this is going to be effective the 1st of March 2022. The rate is valid for the whole tax year unless circumstances change. For example, in our scenario, the pensioner sells the rental property, which means they won't be getting any rental income anymore. So obviously circumstances could change, but otherwise the rate is valid for the year, and then the following year they'll have a look at it again and issue another directive. The whole idea of this whole thing is that the payee could works out to be higher when using the fixed rate. However, you get peace of mind that you're not burdened with the high tax bill at the end. Obviously, this has a bit of issues for especially liquidity, because although it would all well and good to collect via payee that higher rate, but it could mean issues for some of the pensioners, because this is their annuity that they actually were living off. So liquidity could be an issue. Yeah, I mean, you could always continue with the higher rate, like I said, or request an even higher rate in order to buffer for your tax. You could request the administrator to use your normal payee deduction rate. So in our example, you could separate the two and say, I want to stick with the payee rate of 4.32% just on my annuity, and I will deal with my final tax bill at the end of the year. So you could request that from your administrator. This obviously doesn't affect the other directives that are in existence already. Things like your hardship directives, or any other directives in terms of double taxation agreements. This is all separate from that. So yeah, that's it from a fixed interest rate perspective. I know some of the clients would have received communication from administrators already, since the system is in effect, and they might give you a call saying, hey, what's going on? What's this new rate? It's a new tax. So that's basically the gist of it. But obviously, in terms of the actual figures and determining the actual rates, that you'll have to deal with SARS, because they actually come up with that figure. I was just trying to give you a synopsis or an idea of how that rate is calculated. Obviously, the higher the other sources of income are, you'll see that rate will definitely creep up. I've had instances from 30-40%, so it just depends from client to client. I just did a conservative example in mind. So I hope you enjoyed the video, and yeah, let's chat about it if you have any issues. Thanks.